And we're live. Welcome back, everybody, to the Business Emergency Room. I'm Aaron Spool, your host. I've got with me Clint Dewey, who is a incredible real estate expert. He is one of my go-tos when I have anything real estate related, from office space perspective, anything commercial real estate related. We wanted to have him on the show because real estate is the hottest, crazy topic right now, at least in the finance world, of like, what am I going to do with my lease? How am I going to deal with this? If I'm in a co-working space, what do I logistically do? So this is going to be a hard-charging, multi-question. Clint, what do you think the world is going to look like space here? So Clint, before I go a little bit further down the pipe, you want to just give a little bit intro, you, Colliers, kind of explain kind of what you guys are all about, just high level so people in the audience kind of know. And then what we'll do is I'll start peppering you with real estate questions.
Excited. Sure, Aaron, thanks for having me on. So I work for a team of 4 people at Colliers International. We're here based in New York City, and we focus specifically on representing tenants, companies in their commercial real estate needs, office needs, really, here in New York City. We've specialized really in the tech and media sector. I'd say about 80% of our business is in the tech and media sector. So going back, back when I was in college, my senior partner represented Google and relocating them to 111 8th and expanded them up to about 750,000 square feet there. My partners also, when I recently joined the team, represented Facebook in their headquarters space, former HQ space, I should say, 770 Broadway and Astor Place, and expanded them to 20th and Park, where they took another 225,000 square feet. And we've worked with, a variety of other companies, in the space. Those are the big names, but we've also worked with companies like a SoundCloud, as an example, when they were one person here in New York, and grew them to 250 people at peak. They've scaled back and are actually now growing again. So that's kind of the quick spiel on what we do. And we also work, although our specialty is New York City, we are a global company offering a variety of services. My team, of course, does brokerage services, leasing in particular. And when we have a client, hypothetically, let's just say looking for an office in San Francisco, we partner with our office out there, and we can help them if they need to get a space there. Tampa, we've done a lot of deals, Austin, what have you. So we have offices across the country, across the world. And if you're looking for space outside of New York City as well, we can be of assistance as well.
Awesome. That's right. So thank you definitely for the intro. So let's kick it off with some of these will be hard questions, just because it's real estate's panicking everybody right now. But I would say first question would be, what have you seen people deal with the last couple of months? What are people aren't in the office. I mean, they might be starting to come back and things like that. What have you seen from a relationships perspective with a landlord? Because I've heard various stories. Some landlords have been, great, here's some free rent, or here's tack it on the end. Like, what do you see as like the prevailing course? Like, and I know that's
just to give a timeline, that's kind of was more of a March question, I'd say, at this point, March, April question. When the pandemic first started, really the major questions we were getting from our clients were, can we get free rent? Can we, would the landlord give us any sort of abatement of any kind? The answer in New York City from everyone we've spoken to is no. What we've generally seen landlords open, the landlords here are really easy to deal with. What we've generally seen landlords open to, and it's not always the case, but the landlords have been more open to a deferral package of some kind. So going back to March and April, a lot of the conversations we were having is like, how many months of rent are you willing to defer so that our tenant can, get through this time? One I can highlight in particular, I can't say specifics in terms of names, it's a travel company who's obviously travel. It's been, it's not a great year for travel, and they were just getting crushed, and we're looking to save any way they could. They're in a Class A building owned by a premium Reits, real estate investment trust, for those who are not familiar with that term. And we were able to defer, in their case, 3 to 4 months. And that period was from April until the end of June. So it just expired, and pushed that into 2021. We were also, and then there's a payback period, sort of TBD, of what's going to happen in 2021. we were also able to utilize some of their existing security deposits. So that's another thing we started to recommend to our clients, because for anyone who has a lease, one of the biggest upfront costs of a lease is that security deposit. So what we were able to negotiate with this particular tenant on behalf of this tenant was utilizing the security deposit, and they can replenish it at some point down the road. Again, TBD. And the reason I keep saying TBD is the travel industry is still struggling in July, and we wanted to reassess what it looked like this month. So we're kind of in the midst of those conversations as we speak. In the case of this particular client, we actually might have to end up subleasing a floor. They're a larger group, but we'll see. And that's kind of a good high-level overview. It is varied based on a client's particular needs. But I can speak about one client where they have offices, nothing really large, no large office. I think the largest office they have is about 10,000 square feet. They're an office intensive, they're a recruiting firm. So also, I say executive search firm. And they're, again, not a lot of high level recruiting going on during this environment. So they're also struggling. And what we were able to do for them was something similar to what we achieved that travel group I just talked about. We were able to get them a couple months deferred, utilize some of their security deposit, but we were able to do so in all of their markets. So some markets, depending on how many, I don't know the audience of this show super well, but I'm assuming most of it is New York centric. But if you do happen to have a friend or an office or what have you in different markets, I'd say most other markets we've spoken to have been more open to further deferment or larger deferment, and in some case abatement. For instance, we have a client who told us their landlord in LA just flat out gave them 3 months free when this thing kicked off in starting in April, when this thing really was in the doldrums. So it does vary, and it's case by case, but landlords have been working with their tenants during this very trying time. And what we continue to advise, just be very open and honest with your landlord. Don't try and be a bad player, and just be like, we all know there's a lot of tech companies that are doing quite well right now. Don't be like, I don't know, just to use an example off the top of my head, Facebook, who's at an all-time high, just like, you know what, let's renegotiate right now because time sucks. So it's really been more of a personable relationship, open communication. And that's when the landlords have been more willing to give relief as opposed to the bad players out there just trying to take advantage of the situation.
So let's talk a little bit about what rent deferral means, because for some people, so I've heard two different types. I've heard I'm not going to be able to pay rent now. Tack on, say, 3 months. Tack on 3 months at the end of my lease. I'm not using the space right now. Consider that like fallow. But if my lease is supposed to end in December, it's going to now end in March. So I'm basically have 3 extra months of that lease, which I'll pay then. Others have said, take whatever months I'm not paying and then amort that over the rest of my lease. So let's just say that, I don't know if it's, let's not do crazy math here. Let's just say whatever it is, you divide that a couple extra $1,000 or how about maybe tens of thousands of bucks, depending upon the rent, over the remaining term of the lease when I start doing rental payments. So what have you seen more? Were you talking about deferred rent deferrals? What are you seeing between those two?
Generally, what I've seen is if you have a short lease, so we've had a couple clients who have leases coming up either at the end of this year or early mid next. Landlords haven't been too willing to give any kind of deferment in that scenario. What they've understandably looked for is an extension of the lease, in which case you could then probably negotiate for some additional free rent, which would then get you that savings that you were looking for out of the deferment, which is great. But a lot of companies there's a lot of uncertainty out there. So a lot of companies we've spoke with, whether her client or prospect, didn't really have much of an appetite to consider any kind of extension, given that they don't know what the work from home environment is going to be like going forward. And I'm sure that's a topic we'll circle back on later. What I've generally seen in deferment is usually March was because it hit in the middle of March. What we typically saw was somewhere in that April to June range, maybe coming out to July, although most landlords wanted to kind of take a wait and see approach to see what it would look like in July. What we've generally seen is that pushes out somewhere between 6 months to a year. So somewhere around, October, November to some point in 2021 when you spread out that free rent. So the best case scenario, what we really saw was, let's say you were paying, just to make the math easy, $100,000 a month in rent, and you wanted to defer April, May, and June, would take that $300,000, push it to 2021, evenly spread it throughout 2021, and that's how we try it. That was our usually typical goal of paying it back. Some landlords are struggling just as much as tenants out there, to be honest, and they just couldn't afford to do that. So I've also seen scenarios where it's been like kind of more of a double rent situation where maybe you push it out to October and then, starting November or through the end of October and starting November, you pay double rent in, November, December, January, whatever the structure was. So it's really, again, it's case by case, but it's kind of been that was sort of what I just described. It's not the worst case, but the worst case deferral scenario versus the best case deferral scenario is putting everything in 2021.
Okay. So then on that, so you mentioned something about landlords struggling as well. And I've got a number of landlords that I'm close with, either business-wise or friend-wise. And I've been of the opinion, this is just the finance brain in me, if you are highly leveraged, meaning that you own a real estate property, but a lot of it, you've got this giant debt service on it. It's from the obvious perspective, your outflows, you're depending upon the rent to be able to pay those outflows. And so I'm curious of the landlords you've run across. So if you're highly leveraged, you're utterly dependent upon the rent to be able to pay your mortgage on this, to be any other type of working capital, versus someone who's less leveraged because maybe they're a generational owner or they've not really utilize the debt market. So how much have you seen that you think it's that motivated? The scenario that I said is like, what's the ratio that you've seen from like your landlords, or is it just all over?
It's so case by case. Here's a good example. So like we've done a work with, I don't mind dropping this name, Cohen Brothers. Cohen Brothers is a big landlord that's just notoriously one of the more difficult landlords in New York City to deal with. They just, whether their financial situation, usually they tend to take on a lot of debt. So their financial situation is, although the owner itself is very, very, very wealthy, their buildings sometimes are in a distressed situation. So for instance, like going back a few years, they took on WeWork in a large way in 2 buildings where they're, WeWork has not been doing great so far, but they took them on to do that to really fill a gap in their buildings that were just otherwise would have been vacated. They are ones that have been unwilling generally to deal with deferral because they put themselves in these situations where it's difficult. The REITs too, probably because they have a performance to their investors, have been less willing to deal. And like I referenced, one was we were able to get one to do it, but security deposit isn't really a way in which their books are going to be impacted as long as we replenish it long term. Losing rent, if you go to the larger landlords, Related came out with something pretty early on publicly that they were collected 95% of rent. Honestly, I think they kept bragging about it in the news throughout April and May. And then I actually, I do have a document that I could circulate where our research department tracks what landlords have collected, what percentage of rent. And generally speaking, it was pretty high. I'd say most of the REITs have collected in the 90s percentage-wise. So to give you, I don't know if I'm directly answering the question, but what you can see is that there has not been a lot of deferral, at least publicly announced. Now, if you go to a smaller mom and pop, a side street building in Chelsea or Flatiron that we, are probably familiar with, they're the ones that are really struggling the most because they have a lot of tenants who probably don't have these big cash heavy books. So they're probably really the ones that are dependent. Maybe they're dependent on it, just for their meals for all we know. It's more those landlords that have really struggled as opposed to the big ones that can really weather the storm as their financing comes due. And I mean, Aaron, that's a big question that I think a lot of us are sort of like, what could this be another issue that we have to circle back on in 3 to 6 months? Who knows how backed up the mortgage market, the mortgage courts are with, delayed payments and what have you. So that's a really big question that is not really my expertise on the leasing side. But have we seen, as a result, landlords started to get desperate for rents, which I think would kind of be the counter to increase revenues? We haven't. Most landlords really haven't dropped their pricing yet. So, so far, I have not seen a dramatic impact in the in financing world just yet, but totally could see that coming in the near future, without a doubt.
Yeah, because it's interesting. So the question I had, and this is, I don't know if you're able to answer it or not, just from what you said was, when you're looking for real estate space, normally, I never think, I used to never think, put into head, what's the financial status? What's the financing of my landlord? I'm like, here's a building. I want the space. Location. That's the and
Yeah.
location. The three. So I never put that. Do you think that this might be, if there's more uncertainty and things like that, that's something this would ever, like, you think, like the tenants that you represent would ever even think about? Are you helping people find real estate space, would ever say as a selling point, well, this landlord over here is incredibly well capitalized and not highly leveraged, so more likely can weather the storm, which means they're going to be more likely to deal with you?
Yeah.
Or
So, yeah, it's a good question. The thing is, the big issue that is negotiable there in a lease, that's kind of a big tenant question. Because if you're a small tenant, so what big tenants get that smaller tenants can't get is, because they have more leverage and they occupy a higher percentage of the buildings, is they get what's called an SNDA. Subordination, I always butcher the way the acronym here, but it's subordination, non-disturbance, and torment. And what it basically says is, if you go into a building and you're with a direct relationship with the landlord, and let's just say the landlord wasn't being financially responsible or hadn't been or what have you, and they go under. With the S&D, and you had just, I don't know, just to use Facebook as a big example again, they had just built a massive, sexy new office space, put $300 a foot, which is a high number, into a space, and the landlord goes under. If you don't have that SNDA in place, what would happen is the lender, whatever the bank is behind it, could then likely foreclose on the property and have the option to kick out the tenant if they so choose. So why would a lender do that? Well, they would do that if Facebook signed the deal in 2011, or I guess 2021, January 21, when the market was depressed, and they want to maybe they have an Apple behind them that can fill the space. So that's a scenario. At a much higher rent, of course, a scenario where a lender would do that. So the answer is, like, if you have an S&D in place, that the financing comes into play. Outside of the day-to-day aesthetic, like maybe the building's not kept up as well, and the elevators are breaking all the time, and that kind of stuff. But that's more qualitative stuff as opposed to quantitative. So I would say for a smaller tenant, and I don't want to quantify that specifically, but let's just say you don't have a huge percentage of your building, you're probably not going to have an S&D in place anyway. So there's not much, we don't factor it as much into the decision-making at those scale of deals. But could it happen to you? Yeah, it's going to be difficult to get much exposure if your landlord is not being financially responsible.
Okay, thank you. So I want to, before we start, the last half of this is going to be all future of real estate and Clint Dewey's crystal ball. But before that, all right, just letting you know. So before that, co-working. So I'm not talking predict the future of co-working. I don't, and definitely not predict the future of WeWork yet. We might ask that a little bit later. But right now, it's what have you seen there? I've talked with different folks, and from client base, the contacts, and everything else. We're all in the business circles. People are dropping left and right, and if they are in particular longer term arrangements, and I've also had this with I've also spoken to many folks who are in just standard leases, but we should talk about later, of just saying I'm not even going into the building. I'm considering myself not even there. I'm going to deal with the landlord at another time and settle up at another time. So I don't want to talk about that scenario. I want to kind of talk about what have you seen from a co-working perspective? What are they doing? Because COVID is even, and why, audience, why I bring this up is that it's part of the concept of co-working, especially if you're, certain name brands like WeWork, at least in my interpretation as a layperson, is cram as many people as possible into as small a space as possible. And that is now the opposite from a health perspective of what COVID, that perspective. And could be just psychologically in the future. People don't want to be in crowded spaces anymore. Who knows? So what have you seen co-working? Like, what are like the trends that you've seen so far?
Well, so I alluded to it earlier, and it's very public. But most co-working companies have really been struggling through this time, especially the two big names. I mean, WeWork and Knotel are certainly the two biggest New York names. So what we've seen is a variety of things. One, they've been trying to negotiate they're trying to drop a percentage of their leases. So WeWork early on, I mean, WeWork already publicly has dropped out of a large space over on Madison. I'm sorry, 149 Fifth, where there's I think they had about 120,000 square feet there. And they've been trying to, so we've heard, renegotiate with a lot of their buildings and get a better rate. WeWork signed a lot of these deals at a good time in the market. And we knew eventually that them signing all of these deals at a peak was going to be an issue when they got to, recession, depression, what have you. So they've been trying to renegotiate a lot of their deals. I've spoken to a couple people, and anecdotally, I can say depending on the security deposit they have in place, and some landlords got a lot of security deposit from the landlord from WeWork due to the risk they foresaw in the business. They're saying, pay my security and go. And so we kind of predicted that a lot of landlords would actually just take WeWork's build outs and potentially just upgrade them a bit. And utilize the space for their own benefit long term. So there are a lot of WeWork. I don't know if the finishes are as high end as you would get at a typical landlord, but they're kind of nice enough that if you just upgraded them, the layouts work for a lot of variety of tech companies. Even if you have to de-densify a little bit or disperse. Dispersion is kind of the catchy word that we've been using. So there's been a lot of that. They've tried to put together some pamphlets and white papers and whatnot to make you feel better about the spacing within their buildings. But in general, from what we've seen with our clients, I haven't found that they really have a great plan in place. And I think Knotel has a better, they are in a better place to sort of fix a lot of their leases. The problem is that Knotel also is in a similar difficult financial situation. And they publicly announced a month ago, that they're losing a lot of money annually. So in our dealings with them, we've also had to be very careful about what we say. There's a lot of legal conversations coming up, for sure. And a lot of tenants have been like, how do I even know that my WeWork or my Knotel is paying rent to their landlord? So in some instances, we have advised that you should put your rent in an escrow account until you get confirmation that your WeWork or your Knotel is paying rent. Because we have heard instances from landlords that they are not. And that leaked pretty quickly in the brokerage community in New York City. So again, it's kind of a variety of scenarios. The other thing I would advise with Knotel and WeWork is that if you have security deposit with them, they do not put it in an escrow account. It just floats in all of their other accounts. So if you're nervous, I would definitely try and see if you can get your security deposit back sooner rather than later. They call it a retainer in most instances. For the future, it's complicated. I definitely think that, co-working is here to stay. It will not be as big as it once was. It's going to be 50%. Hard to say right now, but I wouldn't be surprised if you see a massive scale back, and I'm certain that some of the companies will go under.
Okay. So I want to pause for a second, just go out to the audience. Remember, the audience, if you've got any questions, you want to ask Clint anything, you're going to ask me something, but realize I'm just the host here. It's all about Clint here. Pop a message in the chat. It's been riveting so far, so no one's popped a question. Pause for a little bit, and then we're going to continue on. And if we see any questions, I'll weave them into the conversation. So just a reminder to the audience, I don't see anything right now. So Clint,
I see one question here, Aaron, from Robert.
Oh, geez, it popped right up. Look at that. Jeez,
yeah.
You're a better man than me. So this shows that I obviously don't know what I'm doing when it comes to hosting. Very embarrassing. Yeah. So what are you advising your clients regarding additional rent obligations? OpEx, general time, override, HVAC, electricity, and management fees, etc. So OpEx is operating expenses. So the additional rent obligations, what do you advise them? Are you advising to take a proactive approach to notify the landlord to cut back or not require certain services? So that's the question of the audience.
That's a good question. It depends where you are. So if you're in a co-working space, as an example, we were able to negotiate actually a decrease in those services. So depending on what, I think the typical co-working number I've heard is somewhere like $12 a foot for a lot of their operating services. So we were able to cut that in half. So they were able to, so that's something I would definitely say in a co-working space. If they're charging you full OpEx, probably would push back and be like, can you please, reduce this? Because you're not getting all the services that WeWork and Hotel promise you, the coffee, the cleaning, et cetera. I don't need to, you know it as well as I do. As it relates to the buildings, it kind of depends. So if you're in a Class A building, call it, just say the Empire State Building, what have you. Most buildings already have included those operating costs into your rent. So I don't see how you can really negotiate out of that. It kind of is what it is. But if you're in a Midtown South building, a class, even though they're cooler in some scenarios, most Midtown South buildings, some downtown buildings generally don't include cleaning in your lease. So it's usually a tenant expense, and you organize a contractor, whether through the building or just a friend of yours who happens to do it. Those you could obviously put those on hold at your own right. Overtime HVAC, I would hope you're not paying overtime HVAC when you're not even in the space, because you shouldn't really have any use for it. But electricity, again, it depends on building to building. If you're in a Class A building, it's usually an inclusion factor. So you've already agreed to pay it. You can ask for it. Is the landlord going to be willing to give it up? My guess would be that sort of goes within the conversation of the rent deferral argument. If you're in the Flex building, the Midtown South building, electric is usually either sub-metered or it's directly metered to Con Ed. So if you're not using it, your rates should go way, way down as a result. Anyways, management fees, et cetera. Those don't really factor in. That's already kind of factored into the rent. So I don't think there's really much you can do about that. But there are certainly areas of operating costs that you should be able to limit during this time.
Okay, well, thank you. That's so I want to kick off kind of the futurist talk. So it's kind of two roads I want to take. I want to talk about future for tenant, future for landlord, and then advice you would give tenants and advice you would give landlords. So let's kick off. Let's do a little bit, as you said before, let's do a little bit of like current advice, like this particular point in time. Like if someone literally just is watching this, they're saying, all right, for the next 10, 15 days, because things change so quickly, what's your current advice for a landlord and your current advice for a tenant or a potential tenant or potential?
Current advice for a landlord, that's putting on a different hat for a minute. I would say prepare your buildings, reinvest in your buildings as if it's going to be there's going to be a pandemic issue for quite some time. So one of the biggest concerns, and really landlords are looking at their lifeblood as tenants, so I can speak about it kind of from a tenant perspective at this point. Landlords are going to need to put in new money into their buildings to create a post-COVID safe environment. So there's a lot of protocols they can put into place. Like if anyone's been in a building recently in New York, it almost feels like getting in a line at Disneyland when you enter the building. There's pass and everything that you have to take. It depends on the building, but if you're going to the Class A buildings, I went to one recently the other day, and I had to follow a very specific pass, stand a certain distance from everybody, like in a lot of scenarios. So there's that. There's HVAC, the new HVAC filters. There's been a lot of, I know it's a lot of speculation, but we've read about how being outdoors is better for the transmission of COVID. So maybe if there's a way to create operable windows, great. Building like One World Trade can't really do that. So anything that I'm just kind of listing, I'm going to go high level examples. Anything that can limit the transmission of this disease indoors is something all landlords should definitely be considering, because a lot of tenants ask us that question. What are they going to do about the bathrooms? What are they going to do about the elevators? There's a lot of those kinds of questions. And I don't think everyone has it fully figured out yet. Just like all of us, landlords are struggling through this, just as much as anyone else. So I would say, and I would also advise that landlords start to drop their rents, but that's my tenant side in particular. Most landlords haven't done it yet. I think that if a landlord were to, and I argue this with, my partner couldn't make it today, but I argue this with my partner, Eric, all the time, that if a landlord were to drop their rent sooner, that they would start to see a flock of tenants enter their building sooner than others. But he has kind of a different perspective, and I think we could go back and forth on that all day. But landlords will continue to offer large free rent packages, especially during this time, whether or not they discount rent. And TI, most landlords are already turnkeying spaces pre-COVID anyway, so I don't think that's really going to change. I just think you're going to see larger free rent packages. From a tenant perspective, I think there's a whole lot of things you need to consider, and the first and foremost is your staff comfortable coming back to the office? That's really where you get to start. So, we did a survey and got some results. They were fairly limited, but when we speak to clients, we have advised them to go back to their staff. And I got close, just Aaron, so you know, I got close to a tenant starting to pick back up in June. And I said to him, I was like, are you sure that you're even going to get 50, they're about a 30-person company. Are you sure you're going to get 30 people back to the office? Is it going to be 10? Is it going to be 15? So what's one, make sure you speak with your staff about whether they feel comfortable coming back to the office. And I would do that maybe monthly, quarterly, because it's going to keep, this is it's become more like a week-to-week event, I would suppose. It was like day-to-day, hour-to-hour at the early stages. But the other things I would consider are, if you have an existing space, is you're going to have to think about social distancing within an office. So and then I'm speaking kind of more from the tech and media sector here, the per square foot per employee was roughly around 150 per square foot for startup companies. Maybe when you graduate to Series D, Series E, and then IPO, it grows to like 175 to 200. Microsoft came out and said that their new square footage is essentially 225 per foot. We envision that the new square footage per employee will jump somewhere between 175 to 200. But the offset there being that rents are going to be down during this time period, and probably will stay down until we have a vaccine or treatment or whatever allows people to come back to the office. So those are the main things I would consider, as we sit here today. But I'm sure there's a couple things that I'm not thinking of right now.
Awesome. So let me ping you on that. So it's interesting from a math perspective. And if I heard this right, I'm not going to go with the square footages, but it seems like no matter how, like if you had like a space for pre-COVID for 30 people, you're not, while you might get a cheaper rent, and let's say you have half the staff coming back that's comfortable coming back, and it makes sense for them to come back, you might keep that exact same space. It's not like you're going down in space because now you need more space for distancing.
Yep.
So I guess
Possible.
So it's all right. So we've cool. Yeah, because my question would be like in somebody's head, if they're thinking like of like a rule of thumb for persons, like if they're just like, if my office space, because very few probably, I don't think of square feet. I just think about, all right, like this, I kind of know what this feels like. What do you think like an internal rule of thumb would be? You need like for like the time being, for like the next until there's a vaccine, right? At least for the next.
Yeah.
I'm not trying to do like future, like trying to predict the future, but like I've got to figure out a space needs like now. Is it of the people that are comfortable coming in? Is it double the space you need? Is it half as much space? Like, what do you think? Just as a simple rule of thumb.
Yeah. So a good rule of thumb that we've heard is we don't, at this point, and it may have been pushed back, we didn't anticipate anybody returning to the office until September. Now, especially tech and media companies, again, they tend to be a little bit more progressive, and they can shift to this work from home environment a little more easily than probably traditional FIRE sector, which is the finance, insurance, real estate sectors. What we've continued to hear is they were thinking of returning about 10 to 25% come September. And then potentially that would scale up to like 50% by the end of the year. And that has been pushed back. I mean, I remember hearing in June, we're going to get 10 to 25%. Now we're here in July, and I don't think any of our clients are back in the office yet. So let's just push it out to September. It's definitely a phased approach. So if you have an existing office, 10 to 25% is kind of the rough estimate we've heard for the next quarter. Let's just say starting in September, like 3 months from there, maybe it scales up 50% by the end of the year. We've had one client who's actually told us that they're not going to send back more than 50% until the end of 2021. But as you alluded to, Aaron, you're going to need more square footage for those people when they do get back. So if you're thinking 50% through the end of 2021, just to use a rule of thumb, try and establish a rule of thumb, which is hard to do. But
Yeah.
I'd say that's probably going to be equivalent to about 75% of the space that you have. Just doing quick math, using 200 versus 150. So you're going to need 200 square feet per person as opposed to 150 square feet per person. So cutting that in the middle, I think that works out to, check my math, I think that works out to about 75% of the space. And that's almost exactly what happened with this client. This client is looking for a longer term lease, so they may be taking a little bit more. But in general, I would say, like, if you're thinking 50% through the end of 2021, probably looking at 75% of the space than you had previously. I don't know. I mean, I'm a little biased. Obviously, I work being in the real estate industry. We thought that was a little conservative because eventually it could scale up. I mean, let's just say a vaccine comes out by the end of the year, and all of a sudden you're like all hands on deck. So it could change at the blink of an eye. But that's where work from home comes in, and I think a lot of companies have found, at least during this time, that it's been productive. We'll see what happens when everybody returns to the office and whether work from home continues to be as productive as it is today.
So I want to talk a little bit about work from home. You just stole my thunder there, which is actually a great intro, but we got a question from the audience. So I want to sum this up because it's kind of long. So basically, do companies that rent space in like large multi-tenant buildings have a say in the safety protocols landlords set for people entering the building, being on an elevator? And then the flip side, can a landlord tell its tenants, here's the safety protocols that you have, like what safety protocols can they enforce versus not?
So it's a good question. Actually, it's not one I've heard to date. So my immediate reaction would be that if a landlord's not doing everything to make you feel safe as a tenant, then they're not going to get new tenants. So I would definitely say, if you feel uncomfortable, reach out to your property manager, whoever your contact is within your building, and say, like, look, this isn't acceptable. This isn't acceptable. The landlord is going to work with you because right now we are shifting from a landlord's market to a tenant's market pretty rapidly. This was one of the hottest markets pre-COVID, I think, actually ever. I think in terms of square footage leased in 2019, it was the most square footage leased in the history of New York City real estate. Now, granted, we have more buildings, but whatever. That's a good beacon to say of where we are to where we are now. So I would say definitely reach out to your landlord if you have any issues. And if you're having issues, you can bet other tenants are going to be having those issues too. And the landlord wants to get that feedback because they want to attract new tenants, especially in this kind of environment. Regarding the landlord really can't do much to your premises, but because it is your space. So, but they can dictate what you do outside of it, obviously. So I'm not saying most people are this way, because in New York, I've seen a high responsibility of people wearing masks. But if you're like a company's like, I'm not wearing masks, the landlord may not let you into their building anymore. It's possible. So I could see a world where that I haven't heard of that happening, but could I see that happening? Absolutely. But no, the landlord really shouldn't be able to dictate anything you're doing in your space, but they should have some ability to dictate what you're doing in the common areas.
Okay, awesome, thank you. Work from home, hot topic. I was literally on the phone with someone, actually I live in Israel, and their whole staff is like, right now, virtual. They're used to internal people, everyone on staff, like they had very little virtual work before, and they're saying that it's actually, well, he hears about this productivity boom. He himself has not seen it, and more like people are getting more and more testy with each other, and without that personal face-to-face, a lot gets lost in translation. And if you're under stress, you're more likely to interpret it very poorly. Now, this is not like a psychological discussion and all, but like, what have you seen from the work from home thought? Because some would say that, there's always a doomsayer saying, well, now with work from home and all of New York is just office space.
Yeah.
Why would anyone, like, I heard Amex is going to lose, or that's everyone throws out like an Amex, like a big giant, not that don't ever have this recording saying this is what I'm thinking that Amex is going to do, but everyone has like a big giant tower, could be Citigroup, whatever, saying, I heard that they're going to lose 9 floors and they're not interested in work because everyone's so productive. What have you seen? Because you're dealing with tenants, you're dealing with landlords, you're dealing with a lot of them. So what have you seen from like a work from home, not like productivity work from home, but like, and this is starting to be like future predicting. What do you think from a future predicting perspective of, and let's just keep it to real estate space. So because that's really what this is all about. Not like, I think for bonus and productive, but like, what percent high level do you think and some rule of thumb, would be a tenant less likely to use due to work from home? So like, is it you're going to need half your space because half your people are going to be working from home any maybe a couple times a week or whatever, or permanently. So what percentage do you think like a longer term cut of utilization would be?
So that's a good question. We actually heard from a big time architect here in the city. They had some early projections that I think are going to come pretty close to holding. So what we had heard is that 75% of people return to the office long term. Well, I guess to say short/long term, because about 15% we're probably going to get let go, unfortunately, given the economy, and then 10% would continue to work from home. I actually think that could come pretty close to holding. I mean, hopefully, hopefully all the jobs come back and most people return to the office. But what I would envision is somewhere between 10 to 15%, maybe slightly less. I mean, the typical range I've heard is between 5 and 15%. I think it could be a little bit higher, but that's maybe full remote. What we have to talk about is also partial remote. Do I think that going forward, everybody's going to be like of that whatever it is, 85 to 90% I just listed? Will they all be going to the office full time? No, I don't think so. I think the typical average is going to be somewhere around maybe 1.5 days a week you work from home. So maybe you show up Monday afternoon because everyone knows Monday mornings kind of stink, and then Friday you work from home. So whatever it may be, but I tend to think that is definitely a future that all industries will adapt to, whether that's because it's a recruiting mechanism or what have you. But I tend to think that the overall long-term impacts on especially in New York City, I'm not going to speculate on the rest of the country, but they should generally apply, is that it's going to be pretty much what's happened historically throughout. I think people will return. I could give you several examples of companies that have sent people home and then brought them back because they thought work from home was the thing to do. IBM is one that comes to mind. IBM sent everybody home for 5 years starting in 2012, then demanded they come back to the office. The general response I've gotten from that, and by the way, IBM did pretty poorly. If you look at their stock history during that time, I'm not saying that's why, but just if you line them up, they happen to. And so I don't know what I've gotten as a response to that is, well, that's there's better technology now. We can we can afford and more easily interact with our employees through Zoom or all of whatever technology you're using these days. But I don't feel that way personally. I mean, I love these Zoom calls. They're definitely better than just not interacting with people on a daily basis. But something about being in person with somebody, I feel like you get to know a person a lot better. It's really hard to get. I mean, hopefully you all love me after this call. But
Tremendous, Clint, best ever. I don't know what you're talking about.
But I tend to think that it's very hard to interact over these Zoom calls and really establish trust in colleagues and whatnot through this technology. On top of that, I keep questioning myself, like throwing real estate aside, can you climb a corporate ladder from your bedroom? Can you? Yeah, I don't know. I mean, maybe you can, but from everything I've seen, it seems like it's pretty difficult to do that. So I did ask I did ask a couple college kids just randomly I saw over the weekend. I asked them this one question. I said, if you and they're both working in they're both finance interns. I said, if Morgan Stanley and JP Morgan both made you the same offer, and Morgan Stanley says work from home remote, or JP Morgan said come to the office like regularly, like we were doing pre-COVID, which job would you take? And they both said JP Morgan. Now that's a small sample, obviously. I'd have to expand this a little bit, but it kind of like just quickly restored my faith in the office market because I do think that young talent coming out of college doesn't want to just go sit at home. And the analogy I came up with there is, I don't know if everyone remembers this, but UBS had a huge presence out in Stamford, Connecticut, because they were trying to cut costs on real estate. And it was very successful for a while. In fact, if you're ever in Stamford, Connecticut, I highly recommend trying to get into the UBS building because it's the biggest trading floor in the world. It's kind of cool, or at least it was. I don't know if it still is, but it's pretty cool to see. UBS is really struggling to get the top talent of the JP Morgans, of the Goldmans, what have you, because they were not in New York City. So what do? They relocated their entire HQ back at 1285 Avenue of the Americas, which is 51st and 6th, so they could get that top talent again. So I tend to equate work from home a little bit to that I think that people want to go out. I think they want to interact and they want to be back in the offices and being with their colleagues. Long term, I think we are social beings, and I think that's what factors into more of the office market coming back stronger than people are anticipating in the news. But do I definitely think that work from home is more legitimate probably than ever? Absolutely, and I think it's going to play a bigger part in our daily lives.
Yes, it's interesting. It says that where work from home only becomes a factor in a real estate perspective is if a physical body isn't there. So if you have half work from, because I've seen a lot of, well, I'm going to work 2 days a week out of my house. Well, that really, unless I'm hoteling or I'm sharing space with somebody else who's there when I'm not, then your real estate footprint's the same size, whether it's being used or not.
Yep.
So and maybe that's also the case of where, because you're balancing, because you're balancing a couple things here. You're balancing, I need more space due to COVID. Then I might have less space utilization due to people work from home. And the question is that it might end up being a giant wash, because it's funny, the numbers that you keep quoting are roughly between, say 10 to 20% or so, and 25% max of extra space needed. But I wouldn't be surprised if, and once again, don't this is all time stamped. Who knows a predictor?
Yeah.
Like if I could predict the future, I don't know if maybe I still be hosting these these events, but I'd be hosting it from my private island as opposed to my home office right now, folks.
Well, that's true. That's true.
Yeah, I think it might.
There's that benefit.
Yeah, it might end up being a wash. I don't know. That's why, I think it's just like anything. It's just too soon to tell. Got
Well, Darren, just for a minute, like I can give you examples of deals where we've kind of seen it go both ways. Like our client is an example of one that's scaling back, at least in the short term, due to work from home. But there's another client another tech company at a similar stage that actually took more space for social distancing during COVID. And then the big deal that everyone's probably read about is TikTok. They actually ended up staying pretty much the same. They had actually, they might have actually expanded by a floor from pre-COVID to now. But so you've sort of seen a mix, and I think every company is going to have a different approach. Some companies might be able to more aptly work from home, and some just may say, you know what, I want to return to the office. I want hold my people accountable. But at the end of the day, could we see a slight drop? Yeah, I think we could. But do I think it's going to be as I heard someone on CNBC say that San Francisco market is dead. I just thought he was so far on one side that it's hard to take those people seriously. At the end of the day, I think it's going to land somewhere in the middle of, work from home to return fully to the office. And I do think it's not going to go full. I think the scale is going to swing more towards working in the office with some partial work at home, like I already said.
So that actually covers, nicely dovetails back into all the future predictions we were talking about. We took work from home and kind of brought it towards landlord intended future predictions. We are getting short on time. I want to be cognizant of everyone's time here as an audience member, and obviously, Clint, your time. Parting thoughts, like parting future predicting thoughts that you haven't already said. Current advice, even more current advice, like, hey, don't panic. These are the things that you should think of. Like, what do you think? Like, if you could say to realize the audience is a mix of landlords, tenants, as well as who's going to watch this? Landlords and tenants and other business folks. So, to the world at large, Clint Dewey, what is your advice?
Boy, that's a good one.
No pressure.
So the real estate market, I guess I'll keep this one fairly brief because I tend to extrapolate a bit on my thoughts. To the world at large, I think that the market, we are starting to see the market open up a little bit. Fingers crossed that there's not another jump in cases here and we have some sort of another lockdown or shutdown or rollback or what have you. But assuming that we continue on this fairly positive trend, at least in New York City, we're starting to see a great opportunity in sublease space. I'm not going to give an exact example, but essentially we saw a $20 drop from pre-COVID to a deal that we're getting fairly close to finalizing soon. So I would say if you are contemplating seriously to look into the market, we're starting to see it in the sublease market, and they're going to start to be a lot more opportunities very, very shortly, and they will continue throughout the summer and probably, frankly, throughout the year. So I would definitely be on your toes about that, because I think those opportunities will go faster than people think. Maybe not right now, but certainly the next month or two. But at the same time, if you're dealing with a direct deal and you're looking to take advantage of this market, look to take advantage in terms of free rent. Landlords have not seemingly been willing to drop their rents just yet, unless you show interest, in which case rumor has been that they will. So I think there are deals out there. Do I think we're necessarily at the bottom of the real estate market in New York City? No, I think we still have a little bit to go. I think once this market is flooded with sublease opportunities, landlords are going to have no choice but to compete. And that will be when the landlords will start to drop their rents, and we'll see some sort of depression in the stats, because we still haven't seen them in our office yet. But stay on your toes. I definitely think that the sooner you start the conversation, the better. And you'll inform yourself more if maybe you get more active today, because if you let it go, I do think there's an opportunity, just like with the stock market, that you could miss a good opportunity to lock in a space for at least a longer term space today.
Awesome. Thank you. Clint, as always, thank you again for everything. I'm actually going to ask you, I'm going to push now one follow-up question on this. Can't help it. Well, I got an expert here. What's a good number to target for free rent? Like what number of months?
Good question. It totally depends on the length of term, but let's just assume, for the sake of argument, a 10-year deal, at least a year. I might say a little bit more. One of the big deals I referenced earlier was an 80,000 foot deal. They got 15 months free, as an example, on a 10-year deal. I wouldn't be surprised if I hear some deals getting done with 2 years of free rent, 18 months of free rent, something like that. It wouldn't shock. That's probably a little high, but I would definitely expect that I'm going to see a deal at some point with 18 months free rent, which is pretty great. The other thing, sorry, Aaron, just made me think of it. We have heard of a market reset, a mutual option to reset for market rates in 2 years from lease signing. So that would be a mutual right. So if hypothetically the market today is $65, just throw out a number, and it dropped to 55 in 2 years, you would have the right to reset that lease. Alternatively, though, if it went to 75, the landlord would have that equal right. So something to keep in the back of your mind. It's one of the bigger landlords who offered us that provision in a lease. Our client didn't act on it, but just definitely expect high amount of free rent, and maybe go for that market reset if the landlord's open to it.
I love it. Clint, as always, thank you again. Promise no more questions right now. I'll have questions for you later. Thank you all for audience attendees, and those that are watching this afterwards on a recorded version, thank you for tuning in. This is Business Emergency Room, Aaron Spool and Clint Dewey here for our guest from Colliers. We're both signing off. Thank you again. Take care.
Thanks, Aaron.
See
Thanks,
you next
everyone.
time.